This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Marc, welcome back to the show.
Thanks for having me, Owen. Been far too long since I've been on, but it's always good to be back.
Well, as someone that's always ranking so highly in all the downloads, it's we can't not have you on. So no, it's great to be back here in Sydney talking to you, mate. Today we're talking about valuations. We're talking about where to find growth and income and these types of things. There's been a lot of things on my mind recently, and you're the right man to talk to. But I wanted to start off with, instead of jumping straight into valuations and markets generally speaking, I wanted to start off with something from your history being around markets. You've been an investment manager, you're a senior strategist now, like you've seen a lot in your time in markets. So I wanted to ask you, for a company or a business model, doesn't have to be like a buy, hold, sell, that's not necessarily what we're going for, but more the business, what's the best ASX or global business model you've come across and why?
It's a good question, Owen. I'm probably the wrong person to be asking this question because from my time in the market, I've realized how hard it is to actually beat the market, which is why most of my portfolio is in ETFs.
Absolutely.
Just because if you look at the ASX, 200 or 300 over the last 20 years, only about 7% of companies have actually outperformed the index. So it's incredibly hard to do. That being said, not that I'm giving advice or anything, but I've started looking a little bit more at the broader Australian market, not just the top 200, but looking at like that 200 to 300 range. And a business that I've been following for a long time is a business called Catapult. Trades on the ticker CAT. They do sports wearable technology and a lot of data analytics platforms for elite athletes. So they've got over 3,000 sport clubs, I think, whether it's from the NFL, the AFL or AFL clubs are with them, the Formula One, NRL. If you ever look at these athletes, they've got this big battery pack almost on the back of their jerseys. That's a Catapult piece of hardware. And they, still pretty small business, just less than, data we're recording this, they just less than 2 billion in terms of market caps. They're still in that small, approaching mid-cap range. But they've transitioned from being a hardware company to really being a software company. Yeah. Their CEO was the chief revenue officer at Audible, which is a subdivision of Amazon. And now you're seeing really, really, and we were talking about this earlier, a business that can drive really, really high margins. And if you have a look at what's happening in the US, all these big tech businesses, these big capitalist machines, these mega cap companies, a lot of them do have pretty high margins, sustainable free cash flow. And Catapult's kind of on that way of doing it. They just became free cash flow positive. And they up 75% year to date. There's a huge market size. I mean, they've got close to 4,000 sport teams and elite athletes, but they want to be closer to 10, 20,000. There's a huge market size. And I think that's what's really attractive. So when you're looking for companies, look at companies that have big addressable markets. Penetration's still low. And with a lot of software businesses, they're on this way of the rule of 40, which a lot of people might have heard, where you take your revenue growth and your profit margins, add them together. And if that equals more than 40, you're kind of on your good runway in terms of operating leverage. And they're now approaching that 40 mark. I think they're in the 30s. So one, I'm a huge sporting fanatic, so I'm very interested in the analytics behind it, but also integrating of AI is that next phase. So being able to have a look at video content of a sporting event and being able to analyze that at the click of a button is incredibly important for a lot of these businesses, because if you read Moneyball, it's all about getting that extra 1% in performance. So yeah, it's a really fascinating business that I've been following. And like I said, it's part of the broader 300, not the 200. It's up 75% year to date. So for those who are not in the broader 300, they might be missing out on some of those companies. Yeah. There's a lot in them. But yeah, that is one company that I think is a really cool business model. And definitely one that has performed quite well this year so far.
Yeah, great. It's a business I've followed for so many years. I actually bought it when it was a hardware business, for what it's worth.
Yeah.
And I watched it draw down again and again and again and get frustrated.
Yeah.
And
I think they were founded in 2006, and it's only, I think, 2 or 3 years ago that they actually pivoted to being a software business, which I think was the right move for them. So, I mean, now that they've got the average customer lifetime, I think, is 8 years, 90+% recurring revenue. They want to be a $1 billion recurring annual revenue business, currently at about, I think, 120 or 140. So it's important, because if you've got even a existing business model, to have the right person there, to have that right structure and the right product development set, I think that's really important when you're looking at investing in businesses.
For sure it is. Yeah. Will Lopez is the CEO.
That's right.
Done a
Will.
great job.
That's right.
Yeah, really great job. The thrust of today's episode and what I really want to talk to you about is, I don't know if this is a structural thing, a cyclical thing, or both. And so I just really wanted to pick your brain about it, because I've been writing about this lately, and it's kind of, I don't know if it spooked me a little bit, but it's just maybe pause for thought with just allocation to markets and just how people think about it. And also from our community's perspective, maybe it's an opportunity just to have a reset on expectations. And when I say that, I mean like a reset on return expectations, because for, what's the long run average of the All Ords or the Australian share market since 1900 to 2025? It's done exactly 12.98% per year as an annual return. So absolutely wonderful. That's in, unadjusted, not inflation adjusted, as raw terms. So that often catches people and they're like, oh wow, 13%, incredible, right? But then we can easily bake that into our expectations going forward. But then I was doing some digging on other markets around the world, and I've got a few things that I want to throw at you. But one of them was that over the last 25 years, the UK stock market has returned 5.2% per year. I got the data, then I had to go back and check it. Like I manually went back to the index 25 years ago and then did the numbers, and I was like, oh, this is really interesting. Since 1900, the UK stock market has gone from 24% of the world's total stock markets as an equity value to 4%. So I see stuff like that and I think, Australia being maybe a very much younger brother of the UK, we talk about productivity, all these things as a political system, but economy as well. Does hearing stuff like that make you nervous, or is it like just one of those things that people talk about from time to time?
I don't think it makes me nervous per se. These markets go through different cycles, but not just that, you go through big structural, almost revolutions. And that's what we saw with the UK. Like you said, they were a huge part of the market back in the early 1900s, the start of the Industrial Revolution. It was all about railroads, textiles, shipping manufacturers. That was the market over there. And if you have a look at what the composition of what the market was in 1900 versus now, the railroad companies have almost handed the baton on to technology companies. And that's why I wouldn't be so worried about if history decides to rhyme and let's say the US isn't the next market to fall. That's where having global diversification is obviously important, because it's very hard to pick those winners.
Yeah.
On return expectations, you're right. We've had a stellar last, call it century or last 50 years, but it's also been combined by major structural forces. And I think that's what's really important for people to look at is what was the regime at the time. People talk about, going through, at the moment, we're now going through this revolution around AI and the information age and now moving to the automation phase. But I think with something like that, these long-term megatrends can last a long time. So the UK has naturally fallen a little bit, and you've seen a lot of the rise of the innovative companies take up more. On returns, you're right. Probably on a real return basis, which I always normally think you're probably looking at around 5 or 6% real returns once you consider inflation. The returns we've seen historically have been quite phenomenal. Going forward, I don't know what's going to happen, but I think a lot of people are resetting their expectations given that we've been, especially since the 1980s, we've seen a structural decline in interest rates. That's propelled valuations higher and a lot of capital finding their way into public markets like equities. And we've also seen profit margin expansion as well. Not just, maybe not so much in Australia, but more overseas. So you're almost having a lot of money being invested into these assets using cheap money for people to either borrow, or there's really no, there was this time where there is no alternative, this Tina approach. Now, bond yields are a little bit higher as well, now yielding more than the equity market in terms of in Australia, more than term deposit rates. So going forward, do we see 12.9%, whatever the stat that you quoted? Maybe not, to be honest, but I still don't see that as being a mean reversion, something that goes all the way back to zero. Volatility tends to revert back to the mean, but these valuation cycles can last longer than what most people think. So overall, I always say invest like an optimist and save like a pessimist, because I'm betting on innovation. I'm betting on capitalism. I'm betting on companies finding their way through a challenging economic period. Right now in Australia, very topical around productivity growth. We're not 100% sure around the economy. Is it sluggish? Is it not? Are the RBA going to cut rates? Is the Fed going to cut rates? I'm still overall optimistic that people should be investing if they have that long-term time horizon. Will we see 12 to 13%? maybe not. There might be a little bit of a setback in terms of returns, but it's staying ahead of cash and staying ahead of your basic cost of living, super important to be invested.
I often think of the return that people can get from markets as the growth, like earnings per share growth or profit growth, plus the dividend yield or dividends, plus or minus valuation. So P ratio, whatever you want to do. And that's a pretty well-established formula, right? Because you've got the growth, the income, and then whatever the exit multiple
what people
is.
are willing to pay for it.
So if you look at markets now, yields seem a little bit more compressed, like 3.1% is the yield on the Aussie market. PE ratios have tended to creep up because shares have run ahead. How are you thinking about that mix?
Yeah, so one thing to realize is that the dividend return is one of the lowest we've seen in a long time. Right now, if you look at the dividend return you can get on the broad Australian market versus what you can get in a term deposit versus what the RBA cash rate is, the last time that government bonds, so very boring 10-year Aussie government bonds yielded more than all those three securities, was back just after the dot-com boom. So we're so we're going back 20 to 25 years when there was this yield discrepancy between investing in equities or leaving your money in cash versus investing in bonds. So that equity risk premium has fallen. And I agree with the way that you look at the decomposition of returns. So when you look at the market did X% last year, what percent was actually from earnings growth, dividends, and that multiple that people are willing to pay. If you look now, 3 to 4% dividend growth in terms of what's expected. Next year, the Aussie market's probably, at least what people are expecting, to grow around 4% in terms of earnings growth. But so that's already an 8% return. And then it's all about that multiple. And at the moment, the Australian multiple is at one of its highest regions it's ever been. There's only been a handful of times in history it's actually been above it. As of the date of recording, it's probably in the low 20 times in terms of future earnings. And historically, it's more averaged around about the 16 to 17 times. And now going through earnings season in August, we've seen some of the steepest moves that we've seen, not just from volatility in share prices, but also that valuation expansion. Yeah. So I'm really curious on that third component you mentioned, Owen. If we've got dividend yield of 3 or 4%, earnings at around about 4%, what are people willing to pay for Australia? Are they willing to pay for that safety of that income, certain more mature businesses? Because if we start to see a bit of a re-rating to the downside, maybe it won't return as much as some of the global peers because they have superior earnings growth in the triple digits. At the moment, a lot of companies aren't really exceeding their earnings expectations. They're exceeding their dividend expectations. But because you've just seen the price run up so hard to all-time highs, the dividend yield's being compressed. Yeah. So that last component is the one that I'm focusing on the most. But I'm not a bear on the Australian market. I think there's innovative parts within the market. I think going broader within the 300, being smart with your allocations to Australia is still a great place to park your money. It's just around that last piece. If the dividend yield's small, earnings growth might not be 100% where global peers are at. The question is, what are Australian investors willing to pay for it?
Yeah, it's fascinating. I like that you brought in the numbers for the forecast of next year. Because we're recording this end of reporting season. But in the beginning of reporting season, CBA came out with its result, got punished. CSL came out with the result, got punished. Yep. And these companies had massive, well, not so much CSL, but definitely CBA had a massive run up into that because it's a stalwart for dividends, consistent profit growth. It still had profit growth and it still had dividend growth. It just didn't have as much as people were expecting. So it does make you pause for thought, I think. I was going to ask you another question about macro, but I might ask you that in a different way. Do you follow the CAPE ratio? Do you think that that's like a worthwhile metric to pay attention to? Because a lot of people that I had on the show, like 2017, I was having this conversation with, and they were saying don't invest because the CAPE ratio is too high and blah, blah, blah. And then even I remember back before the podcast even, people were saying like CAPE ratio, cyclically adjusted PE, for those that don't know, too high, too high, too high. I don't know. Do you have any perspective on that?
Yeah, so first, for definition purposes, the difference between the CAPE ratio and a normal PE ratio is it just smooths out the earnings over a 10-year cycle. So when you quote your price divided by your earnings, it's normally over the last 12 months or next 12 months. There's a lot of cyclicality in that. So Professor Schiller came out with this CAPE ratio, which looks at it over 10 years, a bit more of a medium to long-term cycle. The data does show that when valuations are high, forward-looking returns tend to be worse, right? So when you invest when valuations are low, forward-looking returns are better. That being said, My only issue, and we've used the CAPE ratio before because, we've launched a growth at a reasonable price ETF that is the whole idea around when valuations are really stretched, maybe you want to actually control for valuation and find value disciplined growth. But the issue with the CAPE ratio is it's only looking at a 10-year cycle, right? And I mentioned before that sometimes you've got huge structural mega trends when it comes to big economic events or big structural shifts in the economy that can last half a century. So 10 years might even be, it sounds like a long time, but it actually might be a little bit short. If you look at some of the biggest companies, whether it was, last 10 to 15 years, Apple, Nvidia, before then ExxonMobil, if you go all the way back to GE days, etc., these companies, because everyone talks about market concentration, they can last a long time, like 30, 40, 50 years. So that's my only issue with the CAPE ratio, is that it only looks at the last 10 years. And sometimes these, big powerful forces can be a longer determinant of what's actually happening in the economy. And also, if you have a look right now, I've mentioned around declining interest rates, but you've seen that these massive companies are not just one company, they're companies within companies. And if you break up something like Meta into its own Instagram, into WhatsApp, that could be its own business in itself. So you're actually, while it might look like you're paying a lot for a handful of companies, these are diversified businesses that I have, and you're paying for better profit margins. So in the US, we've had over 12 or 13 quarters of double-digit profit margins. So you're paying for really strong quality businesses. So even though things might look expensive, yes, it is definitely cause to be a little bit wary, but it's not a reason to not invest, because you have to look at the structural dynamics happening in the market at the moment. Look at the CAPE ratio as the guide, but this whole idea of mean reversion that we spoke about before, valuations do not mean revert just like that. They take a long time. And if ever you were invested when the CAPE ratio is high or when the market's high and you missed out on that, you wouldn't have done as well. So even more of a reason, be diversified. And also when you're looking at the CAPE ratio, look at other things. Look at other things like the price to earnings growth multiple as well. Look at what the growth you're actually getting. And even though Australia looks expensive on that multiple, other parts of Asia might look a little bit more attractive, like China or Korea. So for me, it's an important metric to look at. But if you base your investing mantra on where that CAPE ratio is or where other valuation multiples is, it could be a reason not to invest and you would have missed out on all these returns.
Such a good point. Yeah. And I always think this money has to go somewhere, right? So you've already mentioned like 3 different major asset classes just recently. You got Australian shares, term deposits, and bonds. So if you're not in shares, what are you doing? You going to different markets, or you going to, I don't know, term deposits? Well, bonds, should bonds be a better option? Should gold be a better option? Should Bitcoin be a better option? Diversification is so important. It's interesting, as you were talking there, Mark, I brought up the CAPE ratio for myself. This is for the US market. It's 39.
Yep, sounds about right. Last time it was this high was what, back in dot-com boom or GFC?
2000, it was 44. Yeah. Even in COVID, it got to 37. That's because of compression and run up of stock prices. But it's one of those things to be honest, it's never ever in my decision-making process to go and check the Schiller PE. I've got to be honest with you. But it's just something that over time I just am aware of, because the general trend is that since 1980, it's consistently got more expensive. Like, there's peaks and troughs, but It's consistently got more expensive.
Correct. And that's where if you look at it, since the CAPE ratio was invented, the average might be quite low, but you almost have to think of it in average in terms of different cycles.
Yeah.
What was happening with interest rates, what was happening with profitability, earnings growth. Take the macro picture. I think that's really important. So betting that there's a lot of Armageddonists, Owen, in the market at the moment. And there's some great charts that if you listen to all these Armageddonists and rotate it into bonds, you would be doing a lot worse. So use it as a discipline. And when valuations get expensive, maybe look at taking a value disciplined approach when it comes to equity investing to seek out other markets that might have that. But it's not a reason to move to cash. Because like you said, all this money that's in other asset classes has to find a home. And whether it's alternatives, whether it's commodities, whether it's property, there needs to be a pool that needs to grow. And that is what is still pushing up valuations at the moment, but you're paying for very decent earnings growth as well.
Yeah, you are. So I don't want to be the Armageddonist, but I'm asking you the questions because you kind of bring the cool head to all of this. So say, for example, I'm sitting here, I'm thinking, I'm listening to this podcast. 3.2% or 3.1% is what the Aussie market yields. And this is another way to cut up the same argument, I guess. But you're sitting here, you're thinking 3.2% for the broad market Australian shares, ETF or whatever you're buying at home, where I could, get maybe equivalent rates from the term deposit for like 1 year or something like that. Does that general decision-making framework make you nervous? And I guess, how would you approach it otherwise?
For income investors, it's very hard because it's a jungle out there to find high yield. And for a lot of income investors, they are being, I wouldn't call it spooked, but into high yielding asset classes. Yeah. Private credit is the first thing that comes to mind because you're paying, double-digit yields on something that doesn't have a lot of volatility because it's not really mark to market every day. You've got falling residential property yields. A lot of people love investing in residential property. Once you take into account expenses, maintenance, strata fees, all that sort of thing, doesn't look that attractive. So it's tough. It is very tough to find income in a low yield jungle right now. So for investors, I think it's very important to have a diversified set of income producing assets. Still have your equities because, like I said, Aussie companies are still beating on the dividend expectation side. But also, I think it's a really interesting time to explore alternative forms of income. People look at real assets, whether it might be real estate or infrastructure, but you can also get income from targeting, whether it's high dividend yielding companies, which I think is very important, or by looking into other areas like the options market. And you can explore alternative structures like covered calls, which you don't get income just from dividends and from the franking, but you get it from the options premium themselves. And that's where for the market at the moment, if people are thinking things are really, top heavy at the moment, and I can't see the ASX going past a certain level over the next 12 to 18 months, looking at different income sources is very important. Again, it doesn't make me nervous. I think investors need to think about the total return approach. So it's not just about what's the yield on a particular product. Yeah. Right now, you've got certain credit funds or certain bond funds that are yielding more than what you could get in a Australian share ETF as an example. Have a look at that. Maybe it is worth considering, particularly for retiree clients. It's very rare that some of the banking debt are actually paying more than the dividends on the underlying companies that issue the debt. So have a look at that. But overall, really think about that total return. If you're looking for income, don't be afraid to sell some of that capital. And this is not tax advice or financial advice, but to meet some of those cash flow needs as well, especially because a lot of the total return has been made up from price return, particularly amongst the US companies who have a dividend yield of 1% to 2%. Yeah. So I would say and employ everyone to think about it from a total return approach rather than just looking at a dividend or a yield standalone basis without considering that broader spectrum. Yeah,
that's fair. It's interesting because you mentioned covered calls and the pickup that people can get from the options premium. I can't remember the exact figure. What do you think that adds? You may know, what does that add in terms of setting people's expectations to what they might get in an otherwise vanilla product?
Yeah, it's normally around about 4% per year, which you might get. Depends. A lot of things go into options pricing. And this is where a lot of people just tune out. It's just too hard. But when you think about things like interest rates, volatility, these are a lot of the drivers that happens with these options markets. But if you think about it, I'd mentioned before, you're getting about 4 to 5% earnings growth, right, in the broader market. Now, unfortunately, with a lot of covered call strategies, you don't really get a lot of that price appreciation upside.
It gets called away from you.
Exactly. It's capped. But if you think about it from a total return perspective, that options premium is kind of making up for that capital return as well. And you've got something like an Australian covered call ETF, which we have AYLD over here in Australia, that has pretty much returned the exact same as the broader ASX 200 over the last 20, 25 years, but it's done it with less volatility. More income, but from a total return perspective, pretty similar. Yep. So that's where people can explore alternative forms of income. There's a lot of strategies, and ETFs make it so accessible for people to access these different forms of income rather than just the defaults, which is blue chip dividend yields, term deposits, or high interest savings accounts. Yeah. I think it's so great that there's so many different ETFs that can cater to that market.
Yeah, it's interesting. If we do get earnings expectations are accurate and it's a 4% uplift in price in earnings, maybe the share prices rise, say 5 or 10%. Hypothetically, this is all us just hearing the breeze. But if that was the case, the options don't get written that far out of the money, do they? So you could get a little bit of uplift plus the options premium plus the dividend, right?
Correct. So there's quite a number of covered call strategies in Australia. Some are actively managed, some are index-based or passively managed, as it's called. We go for the latter approach, just saving on fees alone, and we believe index investing is a better way to go about things. Some write out of the money. The positives of that is you do get a little bit of that capital uplift, whether you write a few percent out of the money or larger. We do at the money, which means that there is very little, if any, capital growth. Sometimes there is, because what happens with the premiums is they get reinvested back in the underlying stocks. But normally, most of the returns come from the income component. And when you're writing at the money call options, someone might ask, well, Mark, why would you write at the money call options when you can go out of the money and get a little bit of capital uplift? But when you write the at the money, you can actually charge a higher price for them. So you can get more income from it. And that's why we go, because these are income design products. These are not capital growth products. In a bull market, these will underperform. But in a sideways market or a down market, a strategy like AYLD should outperform because the premium acts as a nice little buffer for you. So there's a different range of options. How we're seeing clients use it, have a broad-based fund, whether it's like something like A300, you can bolt it on with a high dividend strategy. And then you maybe want to allocate, of the Aussie equities component, whether it's 5, 10, 20% to an alternative source of income, particularly now in a yield starvation world where there's not a lot of dividend growth, or not so much dividend growth, but the payout is really low, the 3 to 4%. People are going to look for income somewhere else, and you can get it through a liquid basket, just exploring the options market, which was difficult for investors up until the invention of the ETFs, which made it so much easier.
Can I ask one more question on that? I didn't think that we were going to go this deep into options trading, by the way, but I'm glad we did. One of the concerns I often hear from people is the liquidity or the depth of the options market in Australia. How do you think about it?
So sometimes when you look for how fund managers get exposure to certain asset classes, they go to the derivatives market because they are incredibly liquid. So a lot of people think, if I go down the options market, there's no one going to be a seller on the other end or a buyer on the other end. What happens? The good thing is there's a middleman. It's a ASX clearinghouse that handles this. So that's why when you're looking at options, have a look at, are you writing options on the individual stocks, right? Who is the counterparty that you're going with? Or are you doing it through what's called exchange traded options or ETOs? And therefore, you've got a clearinghouse in the middle that will pretty much be there in case the other counterparty doesn't fulfill its obligations. And some of these markets trade in enormous amounts, not so much as the underlying stocks around it, but you've got big institutions who are actually on both the buying and the selling side. This isn't everyday punters like you and me, Owen. Like there are retail investors who trade the options market, but a lot are very sophisticated people, a lot of institutions, a lot of intermediaries. So there's a deep pool of liquidity, and we wouldn't put anything in an ETF that doesn't have that liquidity profile. Because the liquidity of an ETF is really just, you've got the liquidity itself, how much it trades, but then you've got the implied liquidity. And when you've got these options that we roll every quarter, you need to be able to make sure that you can buy and sell them. So liquidity has never been a concern for those because they are exchange traded options. They're very deep markets, a lot more deep in the US. We're still very infant here in Australia around the options market, but I do think it is planning on growing. There's talk of other options markets coming out on different asset classes, whether it be things like gold, etc. So I still see it being a pretty deep pool of liquidity within Australia, albeit not as much as our global counterparts.
That's really interesting. So I don't like false choices, but I'm going to give you one anyway. So false choice is when you don't have to make a choice, like growth versus income or value versus whatever. But I'm going to give you a false choice, and I'm going to ask you to pick between 3 Global X ETFs: A300, ZYAU, and AYLD, with a 5-year view for a retirement portfolio.
If you said 12 to 18 months, I'd probably lean a little bit more towards AYLD just because where valuations are at the moment, just for that alternative forms of income. But I'd still think A300 would form the core base of my portfolio. So I'd have a good, from my Aussie equities component, just for me, probably at least 60, 70% in that. Why A300? So this is the largest 300 companies listed on the ASX. Like I said, you're getting exposure to those broad companies, so that 200 to 300 basket as well, which is really important. And you're paying little to nothing on that. You're paying 4 basis points on something like that. So just because I've seen the historical track record of the market, I'm pretty confident that can form my pillar, my base. If I'm looking for a little bit of extra dividend yield, then ZYAU can play a nice little part in that role to get that uplift. Normally it's an uplift of around about 2%. And then your covered calls can look at, extra 3 or 4% in terms of income. So I'd probably blend them, whether it's like 70% within A300 and then probably 10 or 15% each in the other ones. And then another approach you can look to Australian equity investing, particularly if you're a little bit worried and, Australian markets, the dividends payout ratios of 80 to 90%, is you can actually apply some other smart beta factors like growth at a reasonable price. So GARP. GARP, exactly right. So, back in 2024, we bought out the global version and now we're bringing out, or we've bought out the Australian version as well, which is a great approach because it has outperformed the broader index over a long period of time, and it's trading at a multiple around about in the mid-teens at the moment. So with the ASX trading at, in the 20s, above its 90th percentile, people worried about these big bank valuations. A strategy like GARP is actually underweight the financials. And I know OZXX is a favorite fund of yours, Owen, because it doesn't have a lot of these big cap, financials and material companies. But if you're looking for growth companies, but aren't too expensive, that are still of high quality, when you're looking at the likes, if I look at something in the Australian GARP portfolio, you've got things like Pro Medicus, you've got things like Technology One, real estate, Coles. There's a lot of good quality companies in there that are still part of the broader universe, but have a bit of a smart beta filter. So I'd say A300, core of the portfolio, and then have these little fringes around it to help ballast it in terms of quality, growth, but also a bit of income as well.
Yeah, A300 is like one of those evergreen core holdings, right?
Exactly. It's kind of your sleep at night, don't have to worry about it, keep allocating and keep dollar cost averaging, and that's why we bought it out. But the other things are stuff you can add on for potential outperformance, potential downside mitigation, potential income enhancement.
I was just looking at ZYAU, which is the Global X S&P ASX 200 high dividend ETF. The yield on that's 4.2 at the time of recording, which is pretty good. It comes with a lot of franking credits as well. So it gives you that bit of uplift, but you still got the diversification. I actually really like this ETF for what it's worth. Yeah,
and you also have, it pays quarterly income, but you've also got that idea that it's got that momentum filter, that it removes a lot of these dividend traps per se, and it's focusing on forecast dividend yield. What you'll see with something like ZYAU this year is it might have actually underperformed the broader market because it didn't own CBA.
Yeah.
And I mean, it's maybe a good thing that it didn't in the respect of the recent earnings season when we saw a bit of a fall, but it's because the dividend yield just became unsustainable and it wasn't considered an income stock, as more a growth stock, if that makes sense.
Yeah.
So I do like how it has that filter, and you're holding 50 very, very quality businesses in there that are paying pretty elevated levels of income. Even if it's only 1% to 2%, that can mean a lot when it comes to the current environment, and when you're comparing it to the equity risk premium or the bond yield, it still looks more attractive.
Past performance not indicative necessarily of future performance, as they say, but the fund's actually returned 19% in 12 months to 22nd of August 2025.
Yeah, really solid. Like I said, it's paying really good income. It does have exposure to some of those really like top companies in there, where they're looking at the materials side. That's actually, the materials is an interesting one because they've actually seen a little bit of not so much of a downgrade, but it's really been all about the financial stocks that have done so well, which it does have exposure to, maybe not to all of them, but it still does have a lot of quality material companies in there that are paying relatively high yields when it comes to, mid to high single digits. And importantly, it also looks at a blended of both the market cap and the dividend yield. So it's not like you're going to go into small cap stocks that are paying whatever reason a high yield. You still have that large cap bias as well. But if you're looking for the broader spectrum, that's where A300, 5% to small cap, GARP, even though it is the Aussie GARP version, still looking at the top 200 companies, you're definitely looking a bit more at other factors rather than just size and yield alone.
Yeah, you're right. Like, it doesn't have CBA as far as I can see in the top holdings. It doesn't have CBA.
It did have CBA up until about, I think it was the end of 2024 or mid 2024 when it got rid of it.
See, that's a intelligent decision.
Well, you missed a lot of the run up, but again, a lot of that run up was built by, you talked about earnings growth, dividends, and multiples. CBA's growth, a lot of it has to do with multiples and what people are willing to pay up for it.
But at the same time, it would have been reallocated somewhere else.
Correct.
So
exactly right.
Yeah, you would have got probably some pickup somewhere else.
Exactly.
So, yeah, that's not too bad at all. Not too shabby, mate. Okay. So you've given us those there. A300, ZYAU AYLD, and GARP, which when you did the first GARP podcast with me, that was super popular.
Yeah, and we've recently, north of 100 million now, that fund. We've had a lot of people explore it because a lot of people tended to go to other factors like quality, value. The problem is timing factors is incredibly hard to do.
Yeah.
So by this, you're getting growth because you're focusing on companies with strong earnings growth, strong sales. You're getting quality in terms of things like high return on equity. And most importantly, you're not paying too much. So why pay a premium price when you can actually see really very, very attractively growth profiles that are priced quite cheaply? So we thought, let's bring it out for the Australian market. The global ones outperformed the broader market. If you actually look at our global version, so the ticker code for that is GARP, GARP, it's actually been the best index equity ETF in terms of when we're talking about broad global shares. So think about broad global equities all using a factor. It's been the best performing one since we launched it. Again, past performance, no indicator future performance. And there's only been a couple of active funds that have actually outperformed it. And those active funds are very deep, highly concentrated growth funds. So for a fund charging 30 basis points to be able to do that is incredibly attractive. And we always say, if you're investing in a growth manager, don't use the broader MSCI World as your benchmark. Use the GARP index as your benchmark. And if you're not outperforming that, why are you paying so much for this active manager? So it's been a huge success, and we're just excited that we can just bring a solution like that was reserved for sophisticated investors to everyday investors who just want to access it through an ETF.
That's great. I didn't know that it performed that well. I'm glad. Glad.
It's not because, I mean, we've got a team here at Global X that are picking GARP stocks.
Yeah.
It's following just a very transparent rule. And it said that at the end of December 2024, which I think we recorded the podcast before them, we sold out of Tesla because it was just too expensive. Rotate into Europe because it looked attractive. More recently, it's gone overweight some of the Japanese companies as well, especially the automakers. So it's really just finding these pockets of value that a lot of people might not find. We talked about why valuations are important without doing the hard work for you. And instead of monitoring individual stocks, for me, it's a great way to access global equities.
That's great. Now, coming towards the back end of the show, I don't want to leave people worried or negative, because I get sick of people saying to me, like, I'm going to wait for the market to fall, then I'll buy back in. Or I listened to a podcast, or I read on something or other that's this expensive and I'm going to hold off, or something like that. And we actually have a rule at Rask, just so you know. There's actually 4 rules that you have to pass before you can publish content. And one of the rules is that you have to make people leave feeling better than when they came to you.
Love that.
And so basically, it doesn't mean that you have to just have like bushy-tailed and bright-eyed optimists just running around everywhere, but it does, like, we can talk about things that are important, but at the same time, we do want people to be optimistic about the world, because I believe fundamentally that optimists make more money.
Agreed.
So when it comes to mastering your own psychology, like, how do you think about, I don't know whether you've got any tools, tips, or resources, but just generally, how do you think about balancing all the data that you've just brought to the discussion today with the practicalities of investing, and also how do you find comfort knowing that things like the GARP signals might be flashing red, so to speak, air quotes. How do you think about all that? How do you manage your behavior and whatever?
Yeah, I mean, for me, I'm surrounded by this almost 24/7.
Yeah.
I'm come to work, I read what's happening in the news, I listen to my podcast if I go for a run around what's happening in markets, because I'm just interested in what's going on. But for someone who is looking at this, might feel emotions really overtake in terms of fear and greed. That is what drives the market.
Yeah.
Sometimes over the short term, it's not earnings growth. We talk about earnings growth, fundamentals. That does not impact the market over the short term. It does over the long term. So for me, I like to acknowledge it, but then automate a lot of my investing habits, whether it be things like dollar cost averaging, things like rebalancing, and really trying to almost not necessarily keep a journal, but just remember what this feels like. So if we go back to April, just remember what Liberation Day felt like.
Yeah.
Almost liberating us from all the money that was leaving before it actually came in. And the tough thing now, Owen, is people are used to V-shaped recoveries. What's really interesting is the average retail investor was actually buying during that V-shaped recovery in April 2025 when Liberation Day came in. It was the institutions that were selling because they saw the, tariff wars was going to be absolutely terrible for the economy. So we're going to be net sellers. But retail investors actually behaved better. They said, this is a buying opportunity. Again, that is from recency bias. They thought this is another COVID-19 V-shaped recovery, and it was. Will that happen going forward? I'm not 100% sure. So the good thing is a lot of everyday investors do have good investing habits because they like to buy the dip. But for me, really, loss aversion does hurt, and no one wants to see themselves lose more money than what they gain. But really focusing on automating those investing habits. And the wrong question shouldn't be when is the best time to invest? Because my advice would be the best time to invest is regularly and often, not so much around, should I wait for the PE ratio to come down? Should I wait for the CAPE ratio to come down? That for me is a very, very hard game because then you'll be left out of the market, as we spoke before, and miss out on all that potential upside. So if you can automate those behaviors through things like automatic rebalancing, using digital advice tools, using Rask Invest or a few other tools, I think it's a great way to kind of have those psychological behavioral hacks and also have some fun money, but play with that fun money and have the bulk in low cost ETFs.
Yeah.
That way you don't actually have to touch any of that.
Yeah.
So for me, having a few just little triggers, making sure you remember what things feel like, loss aversion, recency bias, hurting, these are all common, really behavioral factors. Have a look into them. And even though you could read about it, until you've actually experienced it, for me, use it as a learning opportunity. So even if you lose money, think about what did you learn from it? Why shouldn't I have invested in that business? What did I learn about that business? How can I improve my decision making for next time? Me, I've made a lot of mistakes in single stock investing, so most of my portfolio is in ETFs. So for me, I said it before, save like a pessimist, invest like an optimist. There's a great book by, I think it's Hans Rosling called Factfulness. Just talks about how much positivity there is in the market in terms of things we've done with longevity, reducing things like obesity and common risks relating to health. There's so much great news in the economy and with people. So I am an optimist overall, and I think it's important to invest like an optimist.
Yeah, it's probably my most gifted book. That it used to probably be Barefoot or Psychology of Money, but it's definitely Factfulness, that I'd give now. So I'm glad you've read that too, mate, and you're a fan. Well, I think that's a fitting way to end it. And I will direct people to all of the funds that we mentioned in today's show, because the signals that people are probably paying attention to may seem relevant at the time, but it all comes back to, like you said, is that having that plan, knowing how you feel, knowing that money has to go somewhere, and remembering that, these signals might be flashing in one way, but there's maybe a totally other thing that you're missing. Like the world has changed a lot since the 2000s. It's changed a lot since the 1900s. So those stats,
definitely,
they look great or they don't look good or whatever the case may be. But here and now, what have you got to focus on? And I think it comes back to some good fundamentals that you mentioned there, mate.
And just to add on, just separate signal from noise. I think that's really important. Even if you see a red signal or a green signal, whatever it is, have a think about, is it just noise? Should I carry on about my day, or is it something I should be monitoring? I still feel less is more when it comes to investing. You do a great job educating your clients around good principles, good behaviors. We're in this industry, we're taught to do more when news comes out. We're living in a headline-driven market at the moment. Like after this podcast, I'll probably go check my phone to see what did Trump do. Sometimes the less is more when it comes to investing. So I totally attest to all those values that you bring in, that stuff that you've been educating your clients as well.
Appreciate it, mate. Appreciate the kind words, but also right back at you. I know you've managed to fit us in today, and you're about to take a bit of time off, a much needed break, and I wish you all the best with that.
Thanks,
it sounds like a cracker. So enjoy that. But for now, mate, thanks again for joining me.
Thanks for having me, Owen. Great to be here.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.